I'm assuming one thing that investors in fixed income also need to be mindful of is incoming Treasury Secretary Scott Bessent and what he plans to do with regards to the budget deficit. How does that play into your portfolio thinking?
Great point, and a good nuanced question there, Mandy. That I think the way we think about it is one, that the bond market is going to be a very clear indicator that the new administration has to focus on. Whether it's deficits, whether it is the amount of treasuries that we need to refinance, whether it's global investors that we need to entice, not just by yields, not just by higher yields, but also attractive and stable fiscal policy on the other side. So a lot of hard work needs to be done by the incoming Treasury Secretary here in 2025. And then bond market, especially that 20 and 30-year part of the bond market, will be a very clear indicator that the administration should not lose focus on. So that's part one. What are we doing about that in the portfolios? We are staying away from the long end. I think coming back to that dual mandate of fixed income, the dual mandate of fixed income can completely and comfortably be attained by being in the intermediate part. That is the 7 to 10-year part of the yield curve, whether it's treasuries, whether it's your spread sectors, corporate, securitized, etc. And then the end part or that back end, if we think about it, the 20 and 30-year part of the curve is not delivering on that dual mandate and has the risk of the deficit situation and term premium rearing its ugly head at some point in 2025,
Yeah. Vish, listen, for the benefit of viewers, quick translation would be so we get, I guess, a little less technical on that, make it easier to understand. One of Scott Bessent's big jobs, and he's got a lot on his plate, right? He's got a lot to do, is take a closer look at Treasury issuance, because I mean, too much of the issuance right now is at the short end, right? They're paying too much or more than they would like to at the short end. He's got to move a lot more of that issuance down the right-hand side of the curve, which is going to have implications for yields higher that direction, yes?
Fantastically put. And I think there was quite a bit of demand for the short end as investors were clamoring for cash-like assets, which was the front end, whether it was treasury bills or it was the Italian BTPs on the front end. So I think that was where the demand was. And now I think you're starting to see that as you are forced to refinance, whether the demand is going to be staying in that front end, and then where is that demand at what yield level on the back end. So the other way, simplistically to put it, what does this do for positioning in fixed income portfolios? We are significantly underweight the 10 to 30-year part of the curve, and all our duration is coming from the 0 to 10-year part of the curve. So we are neutral, but most of the duration is coming from the 10-year and in, rather than us having exposures on the 10-year and out part of the curve. So steepeners is another way to put it.